If you want to buy something, take a position in a particular stock or asset, you want the price to go up after you have bought it. If you are selling it, then you're hoping the price goes down. But you have to be able to act on those things before they happen.
Welcome to the big show. This is Investing with Confidence. I am your host, Joshua David, and we are happy to have you with us today. Once again, I have a special guest on the show today. He is not special, but he is very special today because he is always here, Mr. Al Connickson. Al, how the heck are you doing today?
Wait a second. Am I special? Am I not special? No, you have me confused.
That was my whole point there.
Yeah, great. Good way to start the show. Hey, I'm doing fantastic. How about you, Josh?
I am doing really good. It's always great to be back, helping our investing family make better investing decisions. And that's a lot of the things that we're going to talk about here today on Investing with Confidence, sponsored by Online Trading Academy, is how us as the average investor can trade like an institution or like a bank or like the financial smart money, right? We had a great week in the financial markets. The S&Ps were up almost 3%. The NASDAQ was up over 3%.
Over 3.
The Dow was up almost 2%. Here's some crazy things, though. The dollar got pounded. There was a rough oil in week, a rough week in oil.
Either way.
Gold had a pretty decent week, but here's another interesting one. Apple really skyrocketed. So there's a lot of great movements up, but also down, depending on which market you're investing with. Let's talk about some of that stuff here today. What's causing some of these markets to go up? What's causing some of these to go down? And how can we use these inverse correlations to our advantage?
Yeah, Apple had a great week. So did Amazon, Google, Facebook. Basically, those technology stocks that have been under some pressure had a really good week. Really what we're seeing, Josh, is a back and forth between issues with the coronavirus still out there, but then the reopening of the economy, that's looking good. But then there's a possible return of inflation and higher rates. There's a number of things. There's kind of that push and pull, that tug of war between those things. But really, I think you got to look at this year, this coming year. There's some strong tailwinds behind this economy. Some great opportunities look like they're going to be coming down the road for us. Next week begins earnings season. And there could be the potential for some blowout earnings coming up, especially because of the low comparisons. But here's the problem with these things, all these back and forth and the different things that could impact the market. All of them result in people having opinions about the market's response to those issues. Here's the fact, folks, no offense, but your opinion doesn't matter.
Oh, come on now.
No, I'm sorry to alert you to that, but what does is knowing how to react to what the markets are doing. Act based on fact, not on opinion. And now is the time to really pay attention to this principle. It's the principle of success at anything, and that's being prepared to act before something happens instead of reacting after the fact. In trading and investing, what is that something that you want to be prepared to act on before it happens? It's price. Price is the most important thing. Price moving in the direction you want it to go. If you want to buy something, take a position in a particular stock or asset, you want the price to go up after you have bought it. If you are selling it, then you're hoping the price goes down. But you have to be able to act on those things before they happen. So the key then to know what causes on a consistent basis price to move is really important. That's the key. If there was one thing that always caused price movement, wouldn't you want to know what that was and use it when you make your investment decisions? You know, if you're going to be buying something, you want to know that the asset is not going to change direction. Instead of going up, it's going to start going down. Same thing when you're selling. You want to make sure that with a high degree of probability, the asset will go down and not go up. Or if it's moving in a certain direction, will it continue? Those are the things that proper price, identifying proper price, can help you to be more accurate with. Really what you want to do is make sure that you have the proper entry and exit positions that give you the best opportunity to have a low risk, high reward trade or investment. And what that thing is, what that something is the relationship between supply and demand. In other words, the relationship between buyers and sellers, but it is specifically the relationship caused by or imbalance caused by the big players, the smart money, the institutions, the Wall Street banks.
You're exactly correct. I mean, so many investors, and it's unfortunate, get into positions or stocks, we'll say, after the move happens. It's important to understand where these moves could potentially happen before they actually do.
Exactly.
Then you're not in that boat of most people that say, man, I wish I would have bought that stock. I could have made a bunch of money. I should have done
Yeah,
that.
woulda, coulda, shoulda.
Right. And it's all about understanding where supply and demand, that imbalance actually is. And that's exactly what moves price. Is more buyers than sellers, price is going to go up. If there's more sellers than buyers, price will go down. It's important to identify that on a price chart. Al, we have a lot to discuss here today. I want to talk about the smart money, how they're using the markets for income in the next segment, but I also want to talk about why there's such a difference in the results of the average investor and the smart money.
Okay.
This is Josh and Al, Investing with Confidence. We will be right back.